In this video, I'm going to go over credit. Our goals are to identify credit, interest, and risk, explain advantages and disadvantages of using credit, identify the types of financial institutions that offer credit, and explain that most credit transactions are voluntary. Using credit allows consumers to obtain the use of money that they do not have to make a purchase. When using credit, the consumer agrees to repay the amount borrowed plus interest. Using credit can allow a consumer to acquire an expensive asset like a home, or it's often useful during emergency situations such as if car repairs are needed and you do not have the cash to pay for it. The disadvantages of credit are that interest and fees apply, so consumers may use too much credit and have a difficult time paying back the amount owed. There are a variety of institutions that provide credit, such as commercial banks, savings and loans, credit unions, consumer finance companies, as well as utilities and medical providers. Interest is the price paid for using someone else's money. When using credit, both parties expect to benefit from the transaction. Borrowers are able to get the money they need to make a purchase, and lenders are repaid the money plus interest. Different interest rates are charged based on whether the borrower is considered a high risk or a low risk. High-risk borrowers would have to pay a higher rate of interest, and low-risk borrowers pay a lower rate. An unsecured loan is a loan that does not require collateral. It's granted solely based on the borrower's creditworthiness. Collateral is an asset used to back a loan. An example is a car loan that's backed by the car that is being purchased. Home loans and college loans usually have lower interest rates than a personal loan or a credit card. A home loan is expected to increase in value over time, and an education will increase the human capital of the student, thus making them more valuable in the workplace. Students need to be careful when borrowing money for college. They don't want to borrow too much so that repayment is difficult. Examples of secured loans are loans for homes or cars. Examples of unsecured loans are loans for college or personal loans and credit cards.